Okay, and if we were looking at doing business with a Chinese company, how can we go about doing a due diligence or understanding a little bit more about who we're going to get into business with?
Well, I think you will need to do like a due diligence exercise for potential, trade or merger and acquisition transaction. And it's always good to have someone professional like KPMG that we can actually have the knowledge and access to knowledge to the organization that you're going to be working with. And always it's important for the business to actually get to know the business partner that you're going to deal with and build the trust and actually try to build the confidence, because you actually, in the end of the day, you're working your business partners. Yeah. And I think that's very important. But there's no good substitute for a very good due diligence exercise.
Okay, and when we have expatriate staff working in China, what issues do companies need to be aware of, and what taxes do you need to be mindful of when you're sending staff into China?
Well, I think there are two main things that the foreign company, like the New Zealand company, really need to look at. Well, for obvious reason, the first thing is you may expose your staff to the PRC, individual income tax, that what we touched on earlier ranges from 5% to 45%. But that will also depend on the duration of stay of your staff in China and also the activities they're going to perform in China. So it will have a more detailed analysis with regard to that. And another important point I think you should know is that sending the staff to work in China may expose you to the permanent establishment risk in China, which is a taxable presence. Yeah. And it may actually bring adverse CIT implication to your New Zealand company by just sending staff working in China. And I think it's good to get an analysis before.
Right.